Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Last week we mentioned how the market was approaching the Fibonacci retracement threshold of 61.8. That price was at 358, and it is no coincidence here that the market consolidated right at that price level throughout the course of the last 5 trading days. This support area now is holding for the market, and we have a couple options at our disposal. If the market breaks below these current support levels at 358, we'd be looking at a potential low to come in at about 354, and that would coincide with where the market is right now with regards to being oversold. Whether the market bounces from here or bounces at 354 remains to be seen, but we only have a few more weeks left before this contract comes off the board. First notice date is in about 2 weeks on February 29th, and so to see this market really consolidate and perhaps move up to retest the 371 level one more time would not be a surprise, but continued price action in a sideways fashion is more probable. It also bears noting that the market recently hit inside of the volatility-based support level of this price action. Given that we are now sitting inside of volatility-based support, after the first time it touches, we'll often notice that the market will either move sideways or up out of this area for at least 6 to 8 bars. So now we're looking at about 3 to 4 more bars in a sideways to upwards price action before we see some potential resistance and another down move. Likewise, the December corn contract is moving off of volatility-based support. And you notice here in the chart, we had a timeline that came in at about February 10th, which coincides with the market touching at the volatility-based support level. After having touched it, just like the March contract, we have been sideways, although most recent price action looks to have given the market a little bit of strength. If we're able to get above the 386 mark and post a close over the next day or two, we would anticipate a small upward movement that perhaps challenges the 395 area before moving back down. Part of why we believe that we may see upward or a sideways to upward movement with regards to corn, again, is because we're oversold and the market is probably due for a bit of an uplift. A few more observations on the December corn contract before we move on to soybean. You'll notice on this contract that we've done very well with regards to our roadmap. That was previous support that has since become resistance. Our red trend line here has been great support for this market where it's bounced off. And we had 2 key turning dates for this contract. The first was the February 10th date. And the February 10th date appears to have caused the down move to start consolidating sideways. The next turn date that we're looking at is February 17th. So it's quite possible that what we'll notice here is the market comes into the 10th, moves sideways, hits the 17th, and perhaps from the 17th we could see a move upward from there that goes up to challenge the point of control, which has been long standing at 391 for this contract. And so this would be in line with the forecasted price action that we were looking for the market to come down, make an advance, and then one more drop as it comes off the board. March beans has been range bound for quite some time. And we can see the boundaries of volatility-based support and volatility-based resistance have truly contained the price action going back several months now. We recently came in and we hit volatility-based support, and the market has since bounced up from there. So we'll be looking probably for the markets to perhaps either retest a natural resistance level near the 885 to 890 area, And if it's able to get through there, we don't anticipate that it'll be able to get much further or much higher then about 900 to 905. Upon making it to volatility-based resistance, this would be a great spot to either cover prices or to tighten stops if you're long in anticipation of a move down. Not only has the volatility-based support and resistance contained the current price action, it's interesting to see here the point of control has been the key area for the resistance, and one standard deviation below that point of control has been key support. As the market has been tagging back and forth against support and resistance here, our most recent price action has us testing the point of control one more time. Again, if this market is able to break through this current point of control area of about 882, we would be looking for the market to make its next advance or next move up to one standard deviation above the point of control, which would be at about 905 as mentioned earlier. November Beans has been in a much tighter trading range, as we'll notice here. We have great support against our natural trend line here that we've drawn. The market has tested it 1, 2, 3 times. We believe a fourth test, should it occur, will probably break. But by the looks of things, the market right now is coming up from being oversold and moving up from there. So we might see a small little test just above near the 905 area for the November contract before potentially moving down. Part of why our bias continues to be to the downside is because the oversupply and lack of demand continues to be the narrative surrounding the soybean market. The point of control for November beans rests at 889 3/4, which is currently where the price has been oscillating back and forth. And so now what we need to see is whether or not one standard deviation below the point of control continues to hold, or if the market's able to make its way up one standard deviation above the point of control. And you'll notice here a little bit of symmetry with regards to the different types of analyses that we're seeing and doing. The 905, 906 number continues to come back. The 890 area continues to return, as well as downside support near 870 to 875 continues to be the theme for these markets. Once we're able to break out of these consolidative areas, the market will be able to trend and we'll be able to understand better the course at which we're going to look to go. The reality is, though, as we look at the soybean market right now, the underlying cycles that we're looking at continue to give us the disposition that the markets want to head lower. In fact, as we head into the planting season, after the planting season's done, we're anticipating that we'll see a continued decline going into the early summer months. July wheat was in a sideways movement for quite some time and had been trading along our trend line, but upon breaking our trend line, it quickly resumed the downward trend that it was in and really declined in rapid fashion. After having made its decline, it came in and hit our end band. And upon hitting that end band, we've seen a small consolidation or a small pullback since then. The interesting thing to note here is over the course of the last 5 trading days, the market has made a pretty large decline. In fact, that decline was about 24 cents. Since that time, coming off of the lows, the market has only been able to regain about 10 cents of that move. And so what we're looking at here is roughly a 38 to 40% retracement of the move. But if you look a little bit more in depthly, what you'll notice is the following. What the market gave up in 4 trading days, over the course of the last 5 trading days, the market has barely been able to regain 40% of that move. That tells us that July wheat continues to be in a weaker position. So even those who are playing the bounce from here on a technical basis should be very careful, because the underlying fundamentals continue to tell us that continued pressure is ahead for the wheat contract. We had a minimum price objective of 464 for the wheat contract. He hit that mark early in the week last week, and upon hitting it, you can see the market has since been consolidating a bit. But also what we believe is the market, upon breaking this 464 area, is probably predisposed to actually making a drop down to the 440 to 450 area as well, which would be at the bottom of our roadmap that we've drawn for this contract. Right now, the market is tracing along this level here and is right inside of one standard deviation below the point of control. A point of control for us right now sits at 497.5, and that's where we see major resistance for this contract. So even if it were able to make some kind of a bounce back up inside of here, we would be looking at potential lower double top, which from there the market would probably decline once again. The market pundits continue to tell us that crude oil stands to reach $20 or so. While on the flip side, we have the likes of Warren Buffett, who's doubling down on his position in the crude oil market, believing that current prices are potentially a reasonable low. It's pretty exciting for us because it's been several weeks now that we have pointed out to you that 2606 was a potential key area of support for this market. And just this past week, the exact low that we found with the crude oil contract was 2605. Below that, should the market come back down and break that threshold, we believe that about 2450 is about as low as the market's probably going to go. But again, that's our best estimate based off of the analysis that we've done. The market also came into our harmonic circle, and as it hit the harmonic, the market has since moved up from there. And so now we're looking at key areas of potential resistance to come in, perhaps around the $32 to $33 mark. Part of why we saw a nice little bump in the market this past Friday is that OPEC reached an agreement with Russia and Saudi Arabia with regards to stopping production at January levels. Whether or not the other OPEC members will also halt their production remains to be seen. Iran has already said that they have no intention of halting their production unless sanctions are lifted. And so it's really a touch and go situation right now with regards to crude oil. Last week, China is now coming off of their New Year celebrations. They were off all of last week, and so they're now back and ready to be market participants again with regards to trading. As we look at the markets now, we'll continue to simply look at what the price action tells us and take action accordingly. Thank you so much for joining us for our weekly market update, and we look forward to speaking with you again next week.